So we got a little bit of economic data, put some pressure on stocks into a near-term pullback that we've been looking for. The question now is, how far down can we allow it to go before it's anything more than a near-term pullback? And how long should that take as we head into a new week? And then what do we expect from there? What kind of moves is the market forecast telling us, the indicator telling us to expect? Our trade idea of the day takes a look at a stock that has not participated in the bounce and how can we trade it to the downside when there's risk that it could bounce up just like the rest of the market at any time. So let's go ahead and get started. Today is Friday, November the 9th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's get right to it and take a look at the market forecast on the S&P 500. And you can see a near-term line pulling back. Actually, earlier in the day today, when we were at the lows, kind of while I was teaching our technical analysis class, our Market Scholars technical analysis class, we were actually trading at the low of the day. The near-term line was below 50. The red line was actually at extreme levels. So and as I mentioned there, of course, on any intraday moves, you always wait to the end of the day, right? Because by the end of the day, we got a longer lower shadow, and we ended up pulling both these lines up. So the near-term line now has stayed up above 50 for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. 9 days. So in 7 to 12 is that normal time frame, which is actually a bit longer than what I expect for that first move because we were coming up from such low levels on the intermediate line. But you notice now the intermediate line's crossed up above 50. So we'll see, that starts what's expected to be a 1 to 3 month rally. According to the seasonality trends, you would expect it to last until January, right? That's when, there might be a little near-term bout of weakness here or there. But the next kind of bigger weakness from a seasonal standpoint is the month of January. And so that's probably where you might get another intermediate pullback. So we'll see. We'll see if we get this kind of a move here, at least initially, because we're coming up off such a big low point, like we were in March and April here. The two lows are a little bit closer to each other, and you had a divergence here on the near-term line and a bunch of other indicators too. But now you got a higher low, and you had some ups and downs. A little concerning that high point there, the fact that we got the dark green shading, but then it turned around so quickly. But now again, you see another bullish near-term divergence that kind of halted that. We did not get to a new low, and we turned and started a new one. So that was a little concerning. This is kind of what what started that 1 to 3 month run. This was a 1 month run roughly between expiration cycles here coming off. So we could get something like this where we might get up to like say 2850, maybe up to these old highs before we meet some intermediate resistance. Right now kind of hitting some short-term resistance and then more of a pullback. But you can see the dark green shading, and that's bullish. That means we have a bullish run that started now. Of course, watch for short-term pullbacks in the meantime. We were looking on the SPY to about 275, what we talked about in class today, for a pullback, and that would equate to 2750 roughly here. So we'll see if that ends up being the case. You look at the Dow Jones Industrial Average, a little bit of an evening star candlestick pattern there. A bullish intermediate confirmation signal, a bullish trend posture with an oversold momentum line that's not extreme, right? It's not below the 5th percentile. So we'll see how that plays out. You can see we didn't get the near-term pullback there either, like we did on some of these others, like the Nasdaq. So we got the near-term pullback there, and see we've got kind of a second one here on the Nasdaq. A little bit more of a decline, a little bit of a bearish divergence with slightly lower highs on the near-term line with higher highs up there. The target for that would be down to about the 7,300 area for that divergence on a near-term level. So again, that might suggest there might be a little bit more weakness early next week in the short term. There's an even bigger evening star candlestick pattern on the Russell. And again, neither one of those two have intermediate lines that have crossed above 50 yet. So we're not all the way bullish across all of these quite yet. So you know, we could very easily get some short-term continuation of this short-term pullback down a little bit more. You can see this could probably go down to about this 1540 level before you get like a inverse head and shoulders pattern developing, a right shoulder similar to this left shoulder where all the clusters were. That would give us a reversal pattern on the chart. Alright, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over that Market Scholars logo right here. Click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells us you want us to keep doing these. Comment further below on anything that stood out to you today or any questions that you have. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day. And join the Facebook community that we created for the Market Outlook. Also, if you're watching this video on our blog, you can also like tonight's Market Outlook tweet by clicking this heart right there. It opens up a new window where you can like that. You can also like the Facebook post for the Market Outlook by clicking on this image and then click those buttons. Those 3 clicks, 1, 2, 3, tell us that you want us to do the video again Monday. It's a quick, really easy way to give us feedback that you can do right now while you're watching. While you're on this page, remember you can also participate in our forums. You have to subscribe to our site to do that, but you can participate in our forums by clicking on this link. And then of course there's our calendar for upcoming classes that we have starting next week. Next Tuesday, or excuse me, next Monday we don't have classes, so these would be Tuesday's classes that we have scheduled. Alright, so we finished the week with a little bit of an upper shadow there, and we didn't quite get up above the 50-day moving average, but the positive sign from a weekly standpoint, at least on the S&P, is that we did close above the 200-day moving average. So we had the big drop below it, and in a matter of 2 weeks, we've closed right back up above it. So a very positive sign from that regard, especially considering last week's long lower shadow, and considering this week we closed above last week's high. In fact, we've closed above the last 2 weeks' highs. 2 weeks' highs there. So a good sign all around. You can also see the Dow did get above its 50-day moving average. The NASDAQ did get above its 200-day, not quite closing above last week's high, so a little weaker there. And you can see the Russell not quite, got close, got right up to the 200-day moving average this week. Not quite back up above it, but you can see if it gets above both those lines, because they're so close together, you know, a positive week next week would get you up above those. Let's take a look at the 3 green arrow chart for the S&P 500. You see we got 3 green arrows still. When you look at the 2-line version of that chart, you'll see that we pulled back down to the 8-day moving average, which is now crossed above the 17-day. That's why your blue line's crossed above 0. So positive sign there. Now, we don't usually go from extreme lows to extreme highs in one swoop. Usually when you get this sharp convergence up towards 0, we might get a little positive before we pull back a little bit more negative. So even, you know, something like this, when we went from a sharp low there, we went up to positive, but then we got a little bit of a pullback. So I wouldn't be surprised if the MACD now probably won't cross below the orange line because it's so far away. But don't be surprised if that MACD doesn't drop below 0 again, which means we might test down into this area just a smidgen below those 2 moving averages like we did over here before popping back up again. But also remember too that those lines, now that they're rising, will act as a support. See, they weren't rising over here. What we did, we popped up, we hit the 8, we kind of crossed below both the 8 and the 17 down, one big down day there on the 24th. Then we hit the divergent low, and then we rallied off of that. So that's your, that's your Dow Jones. Now remember, the Russell's been a little bit weaker, and it's come down and has a little bit below. And you can see again the sharp convergence up towards 0. Don't be surprised if we get a little negative again before coming up off of a higher low that will lead us to more of a sustained bullish momentum. Alright, when you look at the intraday move, we did close above, with the pullback, we still closed above last week's high. We closed in the upper half of the range after creating a new 4-week high yesterday. So isn't that crazy how we were just so extremely low less than 2 weeks ago, and then we created a new 4-week high already, that fast. We did drop down to the 23% retracement of this bounce off of Monday's low, or last Monday's low. So that's where you kind of found some. There's that 275 area. There's some lots of touches. We were looking for pullbacks potentially into that area. with all these touches and last week's high point there. Now you'll see this week's range. You'll have a, the brown line, the low point for this week will be right there where my cursor is, and the high point will be obviously this up here. So you can see we'll have a higher high and a higher low on the weekly chart. So very good sign from that perspective. If we look at the Heikin Ashi candle on the weekly chart, again, you see the reversal signs that you look for are the smaller body than what we've had, and then the long upper shadow, and a little bit of a lower shadow. But you can see kind of similar there. Back in April, we got that reversal, and then, we had a couple weeks there in the end of April. Remember, we're not in the seasonally bearish time of year right now. We're in actually a seasonally bullish time of year. So I don't know if it will exactly behave similar to that reversal. But getting a smaller body and a long upper shadow is a very positive sign from a Heikin Ashi reversal sign. If you take a look at the range here for the body, so that the midpoint of that small little body is 274.03. So we'll go back to this chart and change that purple line. That will end up being 274.03 next week at next week's open. So we'll hit OK there, and there's if we get below that, that will produce a lower shadow, which again, in bullish moves we don't get longer lower shadows. And also remember that this midpoint here is going to be the midpoint for a while, because the high is over here, the low is over there, and now when you're bullish, the low will be over here on the left and the high will be over here on the right. The fact that we're not quite there and we got the low in the middle means that we're just starting. But the fact that we're in the upper half of the chart, we're hitting some Fibonacci support. We're above the open for next week's Heikin Ashi already. All positive signs from a reversal standpoint, and we can see if there is any additional weakness Monday, Tuesday, we can see where it can come down to, and we can be able to find some support in that area. Let's take a look at the range today and the volume. So finishing the week after this big election, keep in mind that we had a gap, so we closed at 280.5. Today's high was 279 and a quarter. So about a point and a quarter range overnight trading. Add that to the 3-point range here. So you had about 4.25 points, a little bit more than 4.25 points. So a little bit below the average. The average range. The volume you can see also a little bit below the average. So when you look at the averages here, you can see the volume is coming down. The 4.25 point range is coming down, still above 1%, but they're coming down, and that's the trend when you're reversing to the upside. And we'll see if that trend continues with a quiet, potentially. You would expect to be more of a quiet week with smaller moves than what we've been seeing now that we are past this election season. If you look at volatility, it's coming down into the weekend from what would be a lower high point again, if that ends up holding. And on a relative basis, that volatility is back into the neutral zone. But remember, that doesn't mean we're out of the woods. It's not until we get below 90 and we kind of solidify that drop below 90. That's when, okay, now volatility is moderating. And you're probably going to have to break down below 15 as well, just because you can stay below 15 for a while. As the intermediate trend makes its way, intermediate run makes its way up for that 1 to 3 month period. All right, so to summarize, the markets have a new bullish posture going, having crossed, but it's not to the point where it's entrenched yet. So expect a near-term pullback at least that we're already having, right? If not more of a brief intermediate pullback. If that intermediate line, because it's so close to 50, if it rolls over, it can get below 50 really quickly. That doesn't necessarily mean, as we saw earlier this year, that it will turn into a bear market, because the next dip, the next near-term pullback, how far down does it get? Those are all things we'll be watching for. So that's how we head into a new week. Short-term weakness early in the week, potentially bounce up to new near-term highs next week. We'll see if that ends up being the case, and we know where some areas of support are over the next few trading sessions to watch if we can get a continuation of what we saw today. So what do you think? Do you agree with that? Do you disagree? Click the poll popping out in the top right corner of your screen. Click on that link, then hit the poll, either agree or disagree. If you click disagree, scroll down to the bottom, comment on what you see. What do you see that would suggest otherwise? I know a lot of people have their opinions, but if you have some charts that you're seeing that tell you differently, we'd love to have you share them with the Market Outlook community, Market Scholars community. All right, if we take a look at how things performed here this week, or at least today, excuse me, you can see long-term bonds rallied. A kind of interesting knee-jerk reaction to yesterday's Fed meeting, where some people took it as more of a hawkish tone in their statement. They didn't make a decision yesterday, but a little bit of a hawkish tone in that they'll keep raising rates no matter what outside pressures may say. You can see the dollar was bullish. That's what you would expect coming out of yesterday, and you also have foreign bonds and preferred stocks there. Down here at the bottom, you can see high yield bonds down, not down as stocks. You can see your highest beta stock asset classes, EEM, IWM, down the most. Remember, they have been bouncing up quite a bit, EEM especially. So a little bit of a pullback in terms of what's been the most overbought. If you were to take a look at from, say, when did we bounce here? If I were to go back to this chart and we take a look at the bounce occurred on the 29th. So let's go back to this asset class comparison. We'll change the time frame back to the 29th. So let's see, be right there up till now, and we'll go with like 15-minute blocks. So again, you can see EEM and IWM were the biggest movers off of the bounce, and so they pull back most today. So that's expected. And one thing that's not bouncing up is crude oil. Crude oil has been down over 10% since the market's been rallying, and with the kind of a shift in the most bullish things coming down, and the most bearish things did not come back up. So it's interesting to see how crude oil has been reacting. If I just look at just this week, go back to the 5th here. So here is a Monday, Tuesday, Wednesday, Thursday through Friday. The S&P had a good week, and it was one of the better performing asset classes. IWM pulled back here today, so pulled back to kind of break even. And you can see crude oil had a really bad week, down almost 5%. And you could say some of that has to do with the dollar finishing the week strong. You see the dollar initially was this was the lowest point that the dollar had of the week, was the highest point besides early that crude oil had. But once the dollar rallied off that low to the end of the week, crude oil was pressured down from a less than 0.5% loss to a 5% loss. So a little bit of an effect from the strong dollar, also an effect from a drop in risk appetite. You can see again from the time that stocks peaked right here. This is where EEM peaked and developed markets, peaked. From that point, you can see it also dropped. So a little bit of a risk-off move into Thursday and Friday, following along with these international equities and eventually U.S. equities that peaked Thursday and been coming down. So a variety of factors putting pressure. Remember too, the main factor that's really been pressuring the crude oil, as you can see, crude oil has really been coming down over the last so many weeks. The last 5 weeks in a row we've declined through the 200-day moving average with this divergence. See, the MACD has been steadily converging towards zero, diverging with the higher highs we've been seeing on the futures contract itself. You can kind of get an idea of where you're going to meet up with some Fibonacci support down here at 56, and maybe even a little bit above that in this area where that low is there. So there's going to be some support in that area, right around 60, right about where we're at right now. But if you notice, the dollar index took off here in April, early April. The week of April the 16th really was the first week that it really took off, and even closed up to 97 here today. But if you look at how crude oil performed from that week of April the 16th, 9th, 16th right here, you can see crude oil actually had some ups and downs, but up until 5 weeks ago, it was actually higher, while the dollar was higher too, and that's not normal. And so I think, because the dollar's up so much from that low point, that the crude oil is finally catching up to where you would expect it to be. See, all this bearishness here is all dollar related too, and so we never did get the pressure on crude oil from the bullish currency that we've seen so far this year. We have never, see that's a pretty decent move to not put any pressure at all on crude, for crude to still be up as much as it was from that point. And I think a lot of what we're seeing now is a correction down to where it probably should have been this whole time, given the rise in the currency. If you go to the sector rotation, here, let's go to this. Let's see, this chart right here, the 1-year chart, and we will change this to a daily chart, and we're actually going to change the time frame to a custom. And let's go back to that week of, let's see, it'd be April, wouldn't it? Oops, hit the wrong arrow. Here we go. So that week of April the 9th is really when we hit the low on the dollar, right? So this is when the dollar, the bullish move that the dollar's had. Well, you can see during the strength, for most of that period, the dollar was so bullish. You can see healthcare, discretionary, and technology were your best performing asset classes. And here, kind of at that pinnacle, energy had been lagging behind. Materials is this green one. You can see it was really lagging behind once, when the market was at its peak. And then industrials is this blue one. It was also lagging. So those areas really suffer, and you got your safe haven areas that suffer. There's staples, and this one would be financials, and the purple is utilities. You'd expect them to lag behind when you're bullish. See, the markets were up 12. The S&P 500 was up 12% off of that low point in April where the dollar took off, right? So that's a pretty decent move for the stock market. And then there's your decline that we had in October, and by the end of it, materials was down here, there's financials, there's industrials, and there's energy. So those are your 3 biggest losers because of the strength in the dollar. So that's what you would expect. We haven't seen the same thing in crude, and so I think you're getting a catch-up move in crude. And again, the question is going to be how much more bullish do you expect the dollar to be, considering the late stage of the business economic cycle, stock market cycles that we typically see. That typically is bearish for the dollar and more bullish for commodities in these areas and international stocks. Alright, so for our trade idea, I wanted to look at this. Some stocks just haven't rebounded. This obviously, Electronic Arts has been a lot more bearish for a lot longer period. I've got the Bollinger Bands up. I got a 5-year volume profile. So you can kind of see how, there was some volume in this area that the stock had hit, tried to bounce off of it, but broke through and has been filling in this gap of volume until we get down into some stronger areas where about $80. There's going to be some strong support for this stock in this area, and it's about as bearish as it's been on a weekly chart. According to the Bollinger Bands, really pushing down. You look at the DMI for Electronic Arts, and you can see how strong the trend is. You've got above average volume. The orange line has been trying to get back below 25. It's turning back up with this kind of breakdown move. It is strongly oversold, so it's not like we want to be too aggressively bearish, but man, that trend is about as strong of a bearish trend as you could possibly get. Here's what the 3 green arrows look like. We've got, well, here, let's look at the 2-line versions of those 3 green arrows. I'd be right here. EA. There we go, EA. So you're coming off that 8-day and you're still pushing to the downside, and there could definitely be a divergence setting up here, and so we want to take a look at that and see. We know that there's some strong support in 80. That's about $8 to the downside. You've got some resistance up here, in this area where we're at. That's where your target level would be for any kind of divergent move back to the upside. So you say, okay, well, how can I trade it if it were to keep going down? But still protect myself if it were to bounce off of these extreme levels. Well, I can sell this 80. In fact, I can sell 285 puts. And you think, well, 80 is the level where the support is, and kind of watch what I'm doing here. So if I sell 285 puts and buy the 90, then you notice here if I were to kind of, you see there's a relatively wide spread, so you have to kind of finagle here and see what can I get. So, if I get around 42 cents of credit, let me analyze that trade. And you'll see that if it were to keep going up higher, then I can keep my worst case scenario to the upside of 42 bucks. Nice little gain there. And if it were to keep going to the downside, because of the $5 credit I got, my break even's actually on the other side of 80 where all that support is. So if it were to stay anywhere between 80 where all that support is and this 90 level, whereas we're kind of breaking down, there's going to be some resistance. That's where the divergent target would be if we were to form a lower low. Then anywhere in this area, you notice I can make a pretty decent gain. With a worst case scenario of 42 bucks up there, I'd have to watch that support for losses to the downside. My maximum gains of 500 bucks, and because I've got a short put here, it's a short put vertical, but I also have a short put, and that's why my loss goes this way instead of this way, which is what the long vertical would be. Then you'll notice that it takes me in this account $8,400. So I get a little bit less than 500 or 5%, because again you get that maximum profit right at that 542 level, and then again the worst case scenario to the upside is that $42 gain here. Let's get that back on the Analyze tab. So essentially I'm selling two 85 puts and I'm buying a long put in case it breaks 85. Right, that's what we're doing, right? So we sell the 285 puts and we get 500 bucks, and I bought the 90 put in case, and you can see there's a spread. If I were to do a market order, I wouldn't get paid. In fact, I'd have a debit. So I get a little bit more money, and the idea being that we can keep going down, and I expect us to pressure down into this 85 area and kind of trade around in there, and I can get a pretty decent gain out of it if it does. So I can make money if it goes to the downside, but if it goes to the upside, then again my worst case scenario is 42 bucks. So I might only make 500 bucks on the 8,000 in margin requirement, but my risk level, like for me to lose 500 bucks all the way down here, we'd have to really break that support, that strong support that's going to be at 80. So really my profit loss ratio is 500 bucks gain to 42 bucks gain. So really good profit loss ratio in that regard, and I can cap it over here to whatever I want. I can cap it to like a $250 loss if it breaks 80 and get out once it gets to this $250 loss, and then now I have a 2-to-1 profit loss ratio. So a bearish trade that protects my risk in case it doesn't keep going down. But if it does come to a divergent low at support and bounces up higher and hits that target and kind of stays in here, then I get a pretty decent reward for the risk that I'm taking on the trade. Not the margin requirement, right, because that's the cash I have to put, but for the actual risk I'm taking on this trade, I can get a pretty decent reward for it. All right, so now I want to get your thoughts. What do you think about this, the market outlook tonight? What do you think about the trade idea? Remember to click that link that's popping out there in the top right corner of your screen and share your questions and comments in with our Market Scholars community in our forums. As always, thank you very much for watching. Remember to subscribe to our channel. Click the thumbs up icon. Let us know you want us to do this again on Monday. Comment on anything that stood out to you in today's video. Follow me on Twitter. Join our Facebook community that we have for the Market Outlook. And again, have a great rest of your weekend, everybody, and we'll see you next time.